Hi, everyone. Thank you so much for joining us. We'll give people a couple more minutes to come in and then we'll get started. Thanks for joining us today, everyone. Okay, I think we can get started. We'll let people come in as they do. But we just want to say thank you, everyone, for registering for today's webinar. We're so excited to have Jessica Starks here today to present on how to build a sellable business. We will be taking questions throughout the presentation, so feel free to send them in the chat or in the Q&A function, and I will keep a monitor on that and make sure that Jessica receives them. If you have any questions, again, in the chat, but I will pass it over to Jessica and she will get started.
All right. Thank you so much for having me today. Thank you all for joining. I think I'm going to be feeling like I'm talking to myself a little bit, so just bear with me, but I look forward to sharing more with you today. So my name is Jessica Starks. I am a business broker and franchise owner of Transworld Business Advisors. So I've been helping people buy and sell businesses for over almost 10 years. And we have a team out there helping business owners do the same. And then about a year and a half ago, I invested in a company, another franchise called Exit Factor. And Exit Factor helps businesses get ready to sell because through the process of us helping people sell their businesses may not be ready to sell. Businesses need to get ready to sell, and we want to get the most money for that business owner. We don't want to see businesses closing their doors, and so it's really my mission and our team's mission to have that transferable asset versus closing the doors. So that's our goal. So today, and I forgot to shut off my phone, so let me do that. There we go. So today I want to talk about how to build a sellable business. So again, thank you for having me here today. So I can't see your hands raised here, but who on this group sees their business as an asset? And then in turn, is this asset part of your retirement funds? So when you're looking at your profit and loss or your personal financial statement personally, is your business on there as an asset? Because really, you need to turn that asset into another line item on your personal financial statement as your retirement funds. So, if you take anything away from our time here together, I want you to remember this, that every single business owner will need to exit their business. Every person on this call. So, the choice is yours today, and moving forward will impact whether the exit is successful for you or if you're going to close your business. So you have a choice to make. You can prepare to exit your business or not. You can choose to ignore the fact and put off your future exit, or not ignore it. And our goal too is, while preparing and controlling your destiny in selling your business, we want to help you improve your business operations today. We want you to be more profitable. We want your business to be less owner dependent. So when you go to exit, your business is more valuable. So I would like this to be in your control and not leaving it up to fate. So let's talk about what we're going to cover today. So we're going to build a valuable company, which means building something that's efficient, again, not dependent on you, and is profitable to secure the future owners, which is you. So after today, you have an overview of how to build a sellable and valuable business, but the work doesn't stop there. This is not a topic that you can learn or master in just this 1 hour that we have together. This is something that you have to make a priority today and not tomorrow. I know how, we put out fires day in, day out as business owners, but this is for you. This is what you need to do to make the best business you have today and sellable tomorrow. So this is going to take a mindset change to run your business like it's going to be sold every day, because it will. Every single person on this call will need to exit their business one day. But the difference is that some of us will have a successful exit where we're going to sell to our family, our employees, or a third party. Otherwise, the others are maybe going to close the doors. And again, that is not a goal that we want to see for any of you guys. So let's choose to control our future exit. Let's embrace it. Let's make that your choice. So, does it require a lot of work? Well, yeah, I'm going to ask you to focus on your business for about 1 to 2 hours a week. So again, you can drastically change the direction of your business, the value of your business. So again, you're working on it, not in it. Today, we're going to cover 2 value factors that drive whether a business is sellable or not and what your business is worth. We also want to talk about the importance of planning and the impact it has. And then we will share with you the first 2 steps to get started and jumpstart you today. Again, as we go through this, please let me know if any questions come up and I'll try to answer them along the way. And then also we'll just continue through these slides and teach you a bit more. So we're going to jump into value factors. So again, what makes your business valuable and then ultimately sellable? So 80% of businesses actually never sell. That's terrible. We want sellable businesses. What happens to the businesses that don't sell? They have a going out of business sign that appears in their doors. The employees lose their jobs, the customers lose their vendor, and you lose the assets that you've built up and spent your heart and soul in creating, and we don't want to see that happen. So we do know that people in our profession are going to say you need an exit plan. An exit plan could be a 100-page document, cost 5 figures to prepare. But in fact, you actually need exit options. What are you going to do when you sell? So you got to think of those exit options. So think about it while we're here today. What are your options? Some of you are fortunate to have family in your business. Maybe those family members are actually the right next step for you. And that takes a lot of heart to find and figure that out. But these are questions that you need to be asking yourself. So what are your exit options? For small to medium-sized businesses, there are only a few options. 1, it could be, again, family. 2, it could be employees. And 3, it could be a third party. So what are your A and B options? What are your first and second choice? So the next question is, everybody wants to know, what's the value of my business? So the key to selling your business is the value and the profitability that your business has. So the business valuation determines what you can sell it for, what kind of financing options are available to you or your future buyer, and most importantly, how much your profit of your business is actually returning to you as an owner. After all, you aren't working for free. So there are many different valuation formulas, but the widest used across our industry, business bankers industry, business buyers, is a multiple of EBITDA. So what EBITDA stands for is your earnings. So you're going to look at your profit and loss statement. So your profit, hopefully it's a profit at the bottom line, you're going to take that profit and you're going to add back the interest you pay, the taxes you pay, not payroll taxes, but taxes like state and local taxes. Also your depreciation. Sometimes depreciation could be an interesting calculation depending on how capital intensive your business is. And then amortization. So a quick and dirty calculation is earnings, your profitability. Then you add back your interest, tax, depreciation, and amortization. That number can be calculated by you. You can ask your accountant for help. Another way to value a business is called SDE, so seller discretionary earnings. What that means is you're going to take your profit, you're going to add back interest, tax, depreciation, amortization, but a lot of business owners take out other benefits besides the profit of their company. Maybe they're taking a payroll, maybe the health insurance, maybe life insurance, maybe the business pays for their car. I've seen some good stuff taken out of profit and loss statements, but we do want to see those clean as well for buyers and bankers. So SDE, seller discretionary earnings, is another way, along with EBITDA, to calculate what your business is making. But the harder number to determine is the multiple. So what is your business multiple going to be? So it's based on industry, it's based how your businesses ran, and this is a range of multiples in your industry. And where do you fit on that scale? So on average, if you are generating revenue in the amount of 0 to 30 million, an EBITDA multiple could be right around 3.5 times. This is different than an SDE multiplier, which can be about 2 to 3 times multiplier. And again, there's a lot of different ways, and that scale of just one, 2 plus 1 is the 3, like that one can make a huge difference. So it could be 2.1 or 2.8 between that range, but that can make a huge difference in the value of your business. So there are two main factors that drive the value of your business and determine what it can be sold for. So the first is the quantity of earnings. So again, the larger the earnings of your business, the more valuable it is. So it's profit over revenue. Notice profit, earnings, not revenue, not employees, not database, but earnings. It's your profit. The purpose of the business is to make money, and the more money your business earns, the more valuable it is to you and your stakeholders, as well as future ones, such as buyers. There's also plateaus of profit. So if your business is making, let's say, $50,000, you're going to see that that multiple is going to be a lot less than if your business was making 250,000 or a million in earnings. And those multipliers go up the more you make. And it really has to do with the more desire, more competition, supply and demand of your company for businesses that make more. And the other thing it has to do with is there's more room for error. So the risk is reduced the more money you make. If you make 50,000 a year, if something happens, if a bump in the road happens, that 50,000 is going to be eaten up a lot quicker than if you're making 500,000. So there's much more room for error, which means risk goes down for the buyer. The second is quality. So the better you run your company, the more valuable it is. So we want to keep your house clean. So that goes back to the financials. Your books and records must be clean and presented in a certain format in order for a business to be sellable or even receive financing or investment capital. Deals and processes vary, but to be able to present clean books for at least 3 years that shows proven history of success, that will support the valuation versus if it was just 1 year. We want you to be the owner over the operator. So again, going back, are you working on your business or in your business? So a business that's dependent on the owner is drastically less than a business that is owner dependent. I know it's hard to do and it sometimes doesn't happen overnight, but in our program, we help owners come up with a plan that works to remove them from the operations of the business over time, focusing on removing the roles from their plate that will create the most value and reduce the risk the most first. For example, if you have a husband and wife team who work in a business who are highly involved in the day-to-day operations, but you have a full staff in place and you're not delegating, you're taking all the control, that's going to be risk for the buyer for you to transition them. It's also going to be hard for the buyer to know everything you do and be an expert in everything you do as a husband-wife team, as the owners of the company. So you really need to look into your staff and see who are those A players that can take some of those tasks and responsibilities off your plate. And giving you back that time freedom is only going to make your business more valuable to your buyer. And then we want you to be better than the rest. Your business needs to be better than your competitors and other businesses because we want to create the competition that Buyers want to buy your business and not somebody else's. Do we have any questions at this moment?
Nope, it
No?
doesn't look like it.
Okay. Feel free to throw anything out there, guys. All right. So the next is a valuable business is, and what's going to make it better than the rest? What's going to make your business a 3 times multiple in your industry versus an 8 times multiple? Yes, we do see a lot larger businesses selling for higher multiples. So we want to make sure your business is efficient. So are you utilizing the resources in your business? Are you maximizing them? For example, utilization of your staff. Are they fully working 40 hours and you're paying them full time, or are they really only working 30 hours? You could, you know, work that out. You could look at margins. Are you increasing your pricing or looking at your insurance expense? As things are continuing to adjust here in the marketplace, just really keeping an eye on what your margins are, because I do see a lot of businesses not keeping up with the times and their margins are reduced, which reduces their profitability. Again, we want you to be above the industry standards. That is your competitive advantage. The business should produce time for you, choices for you, and cash flow for you, not take the life away from you. So remember, why are you in business? And the business should be predictable and recurring. So I know there's always ups and downs in businesses, but there should be a baseline that you can count on from year to year. The businesses that have reoccurring revenue, that's fantastic. So the first thing I'd like to talk to you about is, why is it important to prepare to sell your business now and not wait till tomorrow? The reason why we're talking about this today is because many business owners put this off. This is such an important manner to designing a plan to sell in favor of other urgent matters in your business. Don't forget, this is very urgent. I know the fires you put out every day, but this needs to be top of mind, because 95% of our business owners come to us with a deadline to sell their company in a short period of time. So why is the rush? Are they unprepared or lacking foresight? A lot of our clients never plan to sell their business, which is mind blowing, because selling a business is plan B. Maybe plan A was leaving it for their kids or selling it to a key employee. But sometimes you'll find those key employees actually do not have the funds to put down on a down payment. Sometimes the kids don't have the desire that you had as a business owner when you took over your business. So we we are real people. We're not just entrepreneurial heroes that our family and employees might think we are. We have real problems, real opportunities, and real life crises, which brings us to the top reasons why business owners sell. I have people all the time saying, Jessica, why should I sell? When should I sell? And yes, we can try to time the market, which a financial advisor would never advise. But yes, there's good times in business, bad times in business, but really the time for people to sell is when they're burnt out. They have other opportunities. They have personal reasons, like relocation, illness. Our lives are unpredictable. Humans are unpredictable. I know some of us have thought, I'm never going to sell my business, but we don't get to make that choice, right? All of us will leave our business, either walking through the front door, head held high, you're happy, your business has transitioned, or unfortunately, this sounds really bad, but everybody is going to leave their business, whether your head is held high or your feet first, and unfortunately unable to do that. So having a plan is a huge thing. So I get it. Your business may be your baby and cannot fathom parting with it, especially if you created it, you've owned it for, 30 years. That's a big thing. But is that your only identity, or is that just a role you're playing in your life? Could you achieve the same sense of accomplishment in another business or another role? So keep in mind, when you go to sell your business, it's not going to happen overnight, and it may not even happen in a year. So here are some steps to build a company that is valuable and sellable. You need to have a foundation that's sellable. How do you do that? First, you need to have a valuation and exit assessment of your business. Think of it like a health check. You go to the doctor every year. You need to know how things are going, what might need an operation. And then again, same with your business. What's the value of your business? What's going well? What needs improvement? Where does that value lie? We also want you to have proven results. Again, history of a business success is huge. People come to me and say, "Oh, I just had a good last year." Well, that's great, but how is that going to be predictable for the future if you're not showing me predictability of the past? So, a lot of times buyers and bankers are going to want to see that you've had a good 3 to 5 years of proven history, which makes a huge impact on the value of your business. And after that, you can get ready for your year and ultimately exit. Yes, that exit process usually takes a year or more. We say an average business sells in about 8 months. But there's also that transition period. You have to train, you have to introduce, you have to guide the buyer into the next phases of knowing everything that you've known about this business. So, you, you don't ignore your retirement fund for your entire career and then expect it to be full the day you retire, which is the same for your business. A lot of people tell us that they will plan for their business's future later, but not now. And the problem is they will never start because it's not a priority. It's not necessarily about building to sell, but building and growing a company that can financially maximize your years of hard work now and in the future. You've put your heart and soul into this. A lot of business owners retire, reinvest back into their business, and the sale of their business is their retirement funds or a huge portion of your retirement funds. So don't leave it on the table. We want to help you get the most you can, but you have to prepare today. So forget the dream exit and pick one from reality. You could liquidate your business, milk your company for all the cash it's worth, and close the doors when you're done. It is a viable option for some. You could sell it to a third party. You can transition your business to a family, friend, or business partner, or you can sell it to key employees. So when we talk about key employees, you can think of ESOPs. ESOPs are, more expensive for larger businesses. There's also employee ownership for smaller business there where a group of employees can buy. And if you need a connection for somebody that focuses in that employee ownership on a smaller scale, or you could sell to one or two that are going to be partners, which is, something that we can help with there too. But you need to think about who option A, B, and C is for you. And please don't close the doors unless we can't give you, what you're, you know, if it makes more sense to close the doors, then it does. But you have to explore the option of what is your business worth. I have a lot of people telling me they believe their business is only worth the real estate it sits in, the equipment that they have, where they're missing out on all that goodwill that they've established in their business, which is to do with the cash flow of the business and how you've generated the customers and the employees to run that, producing the cash flow it is. So you could be leaving a lot of money on the table, and we definitely want to explore that for you. So, getting your financials in order. So, the second thing I'd like to talk to you about is getting them in order, which is the number one item that affects the saleability of your company. So, yes, we're going to talk about numbers now, but I don't want it to scare you. I want you to think about this. If you are hiding cash, yes, there's some business owners that hide their cash, and I'm not the IRS. So, but if you are hiding your cash, as an example, to save 30% taxes today, or if you're reporting all your revenue, which then if it's cash, it's flowing right down to the bottom line, you could get 2, 3, 5 times that multiple on your earnings. So, for example, if you're profiting $100,000, but you're afraid to pay 30% in taxes of that cash, that's $30,000. If you took that same cash of $100,000 additional profit and times it by a 3 times multiplier, that's $300,000 your business is worth more. So it's just so important that we get your financials in line. So we want to change the way we think about our,
Sorry,
yeah,
Jessica. Speaking of financials, we do
yeah.
have a question in the chat from Amber. How do you feel about businesses taking a loan out or taking a loan for employees who couldn't otherwise afford to take it over? No debt now and sell with debt to pay the owner out.
Yep. So the first part of your question, how do I feel about businesses taking a loan? So if you have employees that are looking to buy, it is going to be a business loan, but I don't think it should be your liability. So if employees are looking to buy, they can utilize SBA financing to take out a loan to pay you for the business value. Now, those employees are still going to have equity down 10, 20%, and then the bank can finance the rest. They may also ask a seller to carry a seller note. So let's say the employees have 10%, the bank's requiring 20, so you could do a 10% seller note, and then you could from there get the SBA to fund the rest of it. So so yeah, I mean, people to pay 100% cash for a business. I mean, I've done cash deals, which is fantastic, but realistically, cash deals are hard to come by without some leverage, without some debt. So if your business has no debt now, that's great, but this new debt to sell to your employees is going to be their responsibility, and it needs to cash flow with the business. If I didn't answer that, yep, you said thanks. Okay. All right, let me know. Um, all right. So you need to think about your financials, just like you would think about your revenue, your prospecting, your marketing, your customer satisfaction. So think of it like a scorecard. Your business financials are another scorecard that determines the value of your business. That's what us business brokers use to value your business. It's what buyers use, it's what bankers use to give them the funding for your business. So it's crucial. This alone is responsible for half of our deals dying. Again, if you don't have good books and records, your business is not going to get the funding it needs to sell. Or they're going to go back on you as a seller and ask for more seller financing. So we don't want to see all the risk in your hands. So the bottom line is the bottom line. So, number one, keep your books up to date and review them quarterly. And when I say review them, you as a business owner needs to be reviewing them. We have plenty of clients that have entrusted their bookkeepers, accountants, controllers to manage their books, but we still have problems in the deal process. It's not because they're bad people or we can't trust them. It's just because no one knows all your expenses better than you. The owner is the one who cares about their business the most. So here's an exercise for you. We want to help you find more profit in your business. So, you know, maybe this weekend or next month, pull out your financials and your detailed financial statements, your detailed expenses, and go through where you're spending your money. So this is a good exercise by reviewing them on a quarterly basis. But what I want you to ask when you're looking at everything, is that expense still working for you? Or is it necessary? So think about your personal life. Have you been to the gym, but you're still paying the membership? If you haven't been there for 12 months, are you still paying that membership? Or are you still on a healthy meal delivery program that you thought you'd be using but haven't, but you're still paying a subscription, or all the streaming services that we're logged into? How are we still watching on that streaming service? So that's the same type of questions you should be asking for your business. Again, is it still working or is it necessary? Number two, benchmarking your business against the industry. So there's different tools out there that we access, or you could even do some research online. We utilize BizMiner or DealStats. But where does your business fit within your industry? The type of business that you have compared to your competitors. And so we want to look at the expenses you have compared to their expenses to see if you're overpaying or underpaying. For example, you can look up any industry and see what the average rent is, the average payroll, insurance, marketing. You can renegotiate those expenses. And again, we want to make your business more profitable. And so, really eliminating those expenses is key. So, we say in business valuation, revenue is vanity and profit is sanity. So, would you rather do more work for less money, or less work for more money? So think about that. So valuations are complicated for your business. So every dollar that you drop to the bottom line, you're going to be paid two, three, sometimes five times more in a sale. So look at your expenses. That is key. Give yourself a raise. Number three, we want to remove or limit non-essential personal expenses in the business. So if you have personal or non-essential expenses in your business, we need to get them out of there. We need clean financial information. There's a method that we use to adjust those to keep it cleaner. So most buyers of businesses are not entrepreneurs. Actually, a majority of those people are fleeing corporate America. But these corporate-minded individuals do not understand the tax game yet, like business owners do, and why we're doing some personal expenses out of the business to reduce tax purposes. But if they don't understand and the bankers are going to scrutinize it, we don't want to have that problem, which is going to bring down the value of your business. So I'm often asked, what do I do if I want clean books and records and I don't want to pay taxes? Well, there's one way that we have seen and accountants have approved, but you got to run this by your accountant. You could take and have a management expense or a consulting expense and set up a different entity that separates it from the operations. And then you run those expenses in a different operation. But what it does is it cleans up your current profit and loss statement of your operations to be like a management fee that you're really paying yourself, but it's more of a lump sum than individual. So, for example, your personal vehicle, your cell phone, the strategy summit that you and your business partner or spouse went to in Cabo and decided to write that off. It really makes the business financials look so much cleaner if you have one line item that we're adding back versus 10 different line items that they're going to just not really believe in all of those items that you're trying to get credit for. So if you really want to impact the value of your business, then we definitely want to keep you on track for your financials and other areas of your business that impact. So definitely review your financials after this because we can definitely find a lot more expenses to clean up. Is it necessary? Is it working? Are you putting too much personal stuff through it? We want to make your business as profitable as possible. So our next topic, and actually before we move on to that, I want to talk about the economic principle of supply and demand. So the more demand outweighs supply, the larger the supplier can charge. So we have seen this in recent years with used cars, fuel. It's no different than business. So let's talk about buyers and who they are. Private equity buyers make up about 10% of our buyers. Strategic buyers are another 10%. And then individual buyers make up about 80% of our buyers. So what we want to do to attract PE groups or strategic buyers and make the demand work in our favor, we also need to attract the individual buyers coming from corporate. And corporate buyer or like corporate individual buyers are used to doing one job in their business. So 80% of our buyers are coming from the corporate world where they specialize in that one function. We want to make sure they're comfortable. They're typically comfortable in sales or management. But finding someone that can serve in multiple seats like you is finding a needle in a haystack. So if you're wearing 10 hats and you expect a buyer to come take over your expertise in 10 hats, that's going to be very hard with our supply and demand. You might find one person that can do everything you can do. But if you're only doing one task and a buyer needs to take over that one task, your demand is going to be so much greater with the buyers, which is going to increase the value of your business. Again, we want you to be the owner. So this is the last thing I want to talk to you about is getting out of the operations of your business. So you've heard the concept operator versus owner. All right, we're going to stay here. So the concept of operator versus owner. So there's a book out there. If you haven't read it yet, it's called The E-Myth Revisited. But an operator of a business is involved in the day-to-day operations and management of the business. A business owner, on the other hand, does not have any day-to-day responsibilities in a business and is only responsible for high-level management and strategy. In the business world, business brokerage world, we would say this is a semi-absentee or an absentee owner business, which is going to drastically increase the value of your business. Can't tell you how many buyers we talk to that want to be an absentee owner and still do whatever. That's just the golden nugget for a lot of buyers. So we want to talk about the seats on the bus. So how many roles are you wearing in your company, and what are you doing to operate it? So there's roles of sales, marketing, HR, production. So who is responsible for these roles? So again, if you're responsible for two, three, or more seats, that could be a problem. So the less seats that you as an owner occupy, the easier it is to sell your business. So there is a formula for getting yourself out of the roles in your company. Some are more valuable than others. One thing that buyers are cautious of is risk. That is a huge fear, and that's going to be a huge deterrent on the value of your business. They fear that your customers will go away if they're too dependent on you as the owner. The employees will go away because you're leaving. So they want to ensure that the people that are doing business with, working for the company and not the owner. So when preparing to sell the business, the strategy is to remove yourself from the riskiest roles first. So what is the riskiest role? Revenue generating. So sales, marketing, whatever role is most crucial to revenue is the one that needs to be the least reliant on you. If not, what happens when you go away? The sales could as well. So it's a good practice, not just preparing to sell, but in managing all businesses. During a new business, the owner is crucial to generating revenue, but at some point it needs to flip. A good key performance metric is the percentage of revenue generated by the owner should be less than 30%. Another thing I'm just going to fill in here, which isn't necessarily about being the owner, but is customer concentration. If you have too much reliance on your one customer or two customers, that's customer concentration, which again, a buyer is going to say is even more risky for the value of your business, which is going to bring it down. Customer facing roles. So these roles are customer service, account management, or even related to production. So you want to make sure customers are doing business with the company, not you. You don't want to lose customers in this area after a sale, which will then reflect revenue, which will reflect the profitability. So again, you want your buyer to be successful, and you don't want them to come into that dangerous situation where you're losing that. Production roles, if you and the owner are doing the production, that's very hard to train someone. So it's important to train your staff to do production. And so an owner can come in and again, work on the business, not in the business. Because the likelihood of finding that buyer that knows how to do all your skills is going to be hard. And lastly is employee management. So it's usually the last seat the owner gets out of, which moves the business into an absentee ownership. So it's not crucial, but it does make a large difference in the sale price and also starts to pick up interest from strategic and investment buyers, which can pay more than corporate buyers that we have been speaking about. So again, we had a situation where we had a husband-wife team. They were highly involved in the day-to-day operations, all the seats on the bus that they needed to get out of. And initially, our value of their business was $750,000. However, later that year, they decided not to sell to their employees and take the business to the market instead. We increased their value to up 650,000 to 1.4, less seller financing because again, we help them decrease the risk that a buyer saw in their business. So having a mindset that there is always an end and designing a company that can be sold at any time is always going to be worth it. So whether you are ready to sell your business now, you want to sell it in the future, or whether you believe your business will stay in the hands of family or employees for generations, I will leave you with this. Your business is valuable. You have exit options for your business. Your business is valuable and gets the phone to ring with solicitations to sell. And your business is valuable and will sell for maximum value no matter what situation you face. If you choose to prepare and control, your business is valuable. And that is it. So I gave you a little bit time back in your day, but what questions do you have? And my information is on the screen as well. So, I mean, feel free. All my conversations are confidential. Definitely selling a business or preparing to sell, I understand can be nerve wracking. But we do want this to be confidential. I'm just reading something here. So I'm just reading something created an expense. Is this bad as it created an expense? Um, in thought towards stepping out back, we started a new business to whom we rent our new building. I'm not sure if I understand that question. If we're talking about rent expense, for example, we see a lot of times that rent expense may not be market rate expense. So if a owner owns their real estate and they're overcharging them from market rate expense to help with tax purposes, but then they have an LLC as a separate entity, we make adjustments to be market rate tax or market rate rent expense. So we can make adjustments when we're looking at profitability. So for referrals to me, do I have suggested qualification questions? I would love to have referrals. And I would say no. I mean, let's just have a conversation. Everybody's situation's different. I'm very forthright and I ask a lot of questions, but nope, feel free to refer whoever, even if you're 10 years out or 20 years out from selling, or you want to sell tomorrow, like definitely we can have that conversation. So I hope I answered that question. So, why should percent of revenue to owners decrease to 30%? So, this in regard, not decrease, but rather, why should revenue to owners be lower? So, as an owner, you don't want to be responsible for 100% of the revenue because if you leave, who's going to take over that? So, we believe that if you're responsible for 30% and not the whole amount of sales or revenue as an owner, your business is more likely to succeed as you transfer that to a new owner. So, again, stepping out of those roles is key to having a successful business in the future, which is then less risk for the buyer, more profit, or, well, less risk to the buyer, thus more value to you at the end of the day when a buyer sees that's not a risk. Any other questions? Again, I'm happy to have you call me, email me. Happy to answer any one-off questions. And, you know, again, no matter what stage you're in, size of business you are, let's connect.
All right. Well, if we don't have any other questions, thank you again, Jessica, for your time today and all your expertise.
Yeah.
A recording and slides will be available within the next day or so via email. So no worries about that. We appreciate your time this afternoon and we hope to see you at one of our upcoming webinars. Thanks so much.
Thank
Have a
you.
great rest of your day.
Thank you. Bye-bye.